Hi everyone, welcome back to Corporate Decoder. Today we're diving into a financial report that might sound like alphabet soup, but trust me, there's some juicy stuff inside. It involves debt, loans, and a fund trying to make some serious money. Before we jump in, if you like getting clear explanations of complicated business filings, hit that subscribe button. We also have a Discord community where you can chat with other finance fans, linked in the description below. For a Fifth Before community where you can chat with other finance fans, linked in the description below. We're looking at a report dated April 30, 2025 from Nuveen Churchill Private Capital Income Fund. This is a snapshot of a specific financial move they're making, creating something called a term debt securitization. It's like a fancy way of saying they're bundling together a bunch of loans and selling them off as investments. This is also known as a collateralized loan obligation, or CLO, where loans serve as collateral. What's really happening is that the fund, through a subsidiary, a smaller company they own, is taking on a big chunk of debt to invest in other loans. Think of it like this. They're borrowing money to lend money, hoping to make a profit on the difference. This debt is being issued by a company called Churchill NCPCIF Kello 2 LLC, which is fully owned by the Nuveen Churchill Private Capital Income Fund. So while it's a separate entity on paper, it's essentially the fund itself taking on this debt. Here's where it gets interesting. The debt is broken down into different classes, each with its own interest rate and risk level. There's $290 million in AAA rated notes, which are considered very safe, paying interest at a rate tied to something called Term SOFR plus 1.665%. Term SOFR is basically a benchmark interest rate used in lending. Then there's $35 million in AA rated notes, a bit riskier, with a slightly higher interest rate of Term SOFR plus 200%. And finally, there's a whopping $144.07. These don't pay any interest directly. The fund will keep all of these subordinated notes. This means the fund is betting that the overall investment will generate enough profit to cover all the interest payments on the other notes, leaving a nice chunk of change for themselves. The subordinated notes are the first to take a hit if things go south. That's why they are also called equity. Until May 15, 2029, the fund can use the money coming in from the loans to buy even more loans. This helps them keep the amount of debt the same. The fund thinks this whole thing will last until May of 2037. That's when they expect all the debt to be paid off. The deal is expected to close later in May of 2025, but there are a few things that need to happen first. For example, the different parts of the debt need to get good ratings from S&P and Fitch. The fund will manage the loans for the 2025 ESUA, but they will not receive any fee for that. It's important to note that this debt hasn't been registered with the Securities and Exchange Commission, so it can't be offered or sold to the general public without jumping through some legal hoops. This report isn't an invitation to buy the debt, just a notification of what the fund is doing. Now let's step back and look at the big picture. So what does this all mean? The Nuveen Churchill Private Capital Income Fund is essentially taking a leveraged bet on a portfolio of loans. If the loans perform well, they stand to make a significant profit. But if the loans start to default or if interest rates rise, they could be in trouble. Assessment of company direction. This move is all about boosting returns through leverage. It can be a good strategy, but it also increases risk. It really depends on how well the loans are chosen and how well the overall economy performs. Notable risks or opportunities. The biggest risk is obviously the loans not performing as expected. If businesses struggle or interest rates go up, the fund could face losses. On the other hand, if the economy stays strong, this could be a very profitable move. Conclusion. This is a high-risk, high-reward strategy. It's not necessarily a bad thing, but it's important to understand the potential downsides. Anything notable, the fact that the fund is keeping all the subordinated notes shows they have confidence in the overall investment. But it also means they're the first in line to take a loss if things go wrong. Alright, that's our breakdown of Nuveen Churchill Private Capital Income Fund's latest move. What's your take on this debt securitization? Do you think it's a smart move or too risky? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. See you next time.